So, the new economy and the valuations that we were talking about on Open Mic yesterday, we're going to dig into this a little bit more deeply with our good friend Professor Mark Guttner of Rutgers today on Open Interest. Hello, everybody. Oh, so I don't know why I keep forgetting that the bell is coming. Hello, everybody. Welcome. I'm Mike Coe. Welcome to Office Hours with Professor Mark Guttner. How are you, sir? Are you in your office or
Yeah, I'm
in
at
your home
home
office?
because we're snowed in, and
Oh
they
yeah,
didn't
and
want the
another
kids to
blizzard.
try to drive to campus today. So they just said do classes online. I think we'll be okay tomorrow, but today it is what it is. Um,
How about, let me ask, I mean, how many students at Rutgers are commuting in, would you say? What percentage
I don't
versus,
know. It is kind of
uh,
a commuter school, so 30%, 40%, something like that.
yeah.
Um,
I don't recall when I was in college that they would ever cancel classes for snow.
they only did it
Uh,
once at
I might,
Michigan.
I might, I might have canceled it. Just taking a look outside and said, maybe not.
They only did that
but
once at Michigan in the 7 or 8 years that I went to school there.
yeah.
And that was like we got like 6 feet of snow. You had to tunnel your way into the buildings.
So yesterday I was talking about a couple different things, and in fact, you know what I'm going to do is I'm going to bring back the same slides that I had on yesterday's open mic live stream.
Okay.
And one, because I've been seeing this get a lot of play recently, and I would have loved to have had you opine on this. So a lot of people are talking about the Buffett indicator,
Hmm.
and they talk about the Buffett indicator, which is basically equity market capitalization, all equities divided by GDP, as a barometer. I'm going to end that slideshow because I don't even know how that's going to. So here we are,
Yeah.
as a barometer of the market's expensiveness. And this is from something called currentmarketvaluation.com. I stumbled across their website. I rather liked the visuals that they came up with because they not only showed what the number is, but they also showed a trend line, how that trend line has migrated through time, and one standard, two standard deviations above and below the respective trend. As they pointed out, this is a little old because this one dates to September 30th. So basically the tail end of the third quarter. What you're going to see
Yeah.
up here in the upper right is that a U.S. equity market capitalization to GDP was about 225%. I saw a number from Bloomberg on Friday that it was 230, and I can actually verify that on Bloomberg. The reason I'm not using the Bloomberg screen is because Bloomberg's data doesn't go back this far. They only go back to it's like 2007, I think.
Yeah.
So they don't really have as much history. And 2007 is an interesting time for it to commence because the Buffett indicator, I think, was first most widely publicized after Buffett himself did an interview with Fortune magazine in 2001.
Hmm.
All right, so that's just looking at the Buffett indicator, U.S. stock to GDP. So I'm going to punch through these slides really quickly and then ask you to opine. The next one is a 10-year PE ratio. So this is kind of Robert Shiller's work,
Yeah.
and I forgot. He had a collaborator on this, and I forgot who it was. Case. Was it Case? Oh, no, that's maybe their real estate
That's
index.
the real
But
estate
Robert Shiller's
people.
so Robert Shiller's a professor at Yale, and he thought that a good way to look at equity market valuations was to take a cyclically adjusted PE ratio, what some people will abbreviate as the CAPE ratio.
Hmm.
So by taking a 10-year history, then you are essentially going to get rid of the noise associated with the business cycle.
Right.
And here too, you can see that at least as of the end of the third quarter of last year, S&P looked expensive, not as expensive as it has ever looked. That was the tech bubble, but certainly expensive. Another way to think about it, price to sales as a multiple. Now, I would just quickly point out that and these things are related, that price to sales, we've never seen companies as profitable as Nvidia on a percentage
Yeah.
basis that I can ever remember. I mean, 55% after tax profit margins
Yeah.
is, I mean, it means most of their revenues convert to profits even after taxes,
Yeah.
which is just absolutely remarkable.
Yeah.
And then value relative to interest rates. This is something I think that is, worth thinking about. It's hard to make out here on this particular chart, so we'll show it in another way. This faint red line in the background, if you're paying attention, I'm going to try to trace it here in green. I'm assuming is that the 10-year rate, but that is interest rates, because you can see that we had a
Oh, okay.
multi-decade trend. So that is the rates. And then finally, if we take a look over here, this is just going to show the S&P earnings yield versus 10-year Treasury yields.
Yeah.
The earnings yield, just as a quick reminder for anybody who's watching who doesn't hear people talk that way all the time, it's just the inversion of the PE, right?
Yeah.
So if you say the PE is 20, you invert that, 1 over 20 is 5%. So that's the earnings yield. And that's the way to think about that number. And one would expect that as rates drop, then people's expectation for what they're going to make off of their investments of whatever type they are going to go down. And as rates rise, then
Yeah.
the amount that investors are going to expect and demand will rise. So what are your thoughts, first of all, about these slides? And is there any one in particular you'd like to highlight to talk about? So
We can talk
just
about all
the
of them, but we can stop at the last one first. We'll start with the last
okay.
first. I use this chart in my classes, but what I do is I take a scatter chart of this and compare yields to the on treasuries to the S&P 500 yield. This I don't know if he made this famous, but people said that Greenspan used to use this model. They used to also call this the Fed model for equities. And you get a nice line with that, with an R squared of like 0.55 or something like that. Pretty significant, and gives you a bit of a predictor of what the price to earnings ratio should be given the treasury rate. Now, the only other thing that is kind of missing in that analysis and what makes it deviate is growth rates. If growth rates are faster, you would expect a lower earnings yield, higher prices, and vice versa. And if you want to get an estimate of what you think the expected market return is for an upcoming year, you take the current earnings yield and then add some growth rate that you think is appropriate for earnings yield, and put those two together, you get an expected return on what you think the S&P 500 ought to be. And that's how I teach this part in my class, about one of several different ways to think about an expected return on the market portfolio. So I like this chart. I use it, and I think it makes a lot of sense, because bonds are competing with stocks, and the difference between stocks and the 10-year bond is the 10-year bond is like a stock with no growth, right? You're going to get that fixed coupon for 10 years. Maybe even a better one might be the 30-year bond, but the yields between the two are not really that different. I might go to the second chart and comment on that one. And the PE, this is the CAPE ratio.
Oh, this isn't the CAPE. This is just, oh, yes, I'm sorry, it is. Yes, this is the
And
CAPE
I
ratio.
think that's a good one, because there is a bit of a cycle, but there's also periods of time, some companies that will be writing down assets, right? Something will happen. It also not only does it wash out the business cycle, but it also helps get rid of the effects of one-time charges and earnings, which can affect a company's earnings and therefore affect its PE ratio. So I like this one as well, and it does tell us that we are a little on the high side of things. The first chart is one that I find particularly disturbing for two notes. One is the data is what it is. Um, but if this was a true metric, then it should not have lines that are going up. They shouldn't be sloping up. And you know, the what was fair value in 1970 um, as a stock market to GDP ratio. That if that's a true metric, that metric should hold here in 2020 or 2025. And we can see that is going uphill. And so this metric tells me that overvaluation is even more extreme than what it's implying. Because your median or your historical trend line is going up. And like I said, if it's a proper metric, it would be a horizontal line, and we're just going above and below that historical line. So that's a little bit disturbing because I would suggest that the overvalue in equities is even worse than that's suggesting. And then the other one is what was private equity in 1960 versus private equity in 2025?
Much smaller.
Much smaller. And this is kind of the underlying assumption. And this is private equity is about the same size. Private equity is even bigger, right? Way bigger. So that would suggest to me that maybe equities are even more overvalued than this chart suggests. So those would be, you know, my number one comments on this. I think for most people, they know that things are overvalued to some extent. But two things I think, or I don't know if there's two, but one that's going on, I think this kind of reflects that ongoing Fed put that nobody talks about anymore. I think people kind of think it's there. And so you need to invest more in equities, or you're confident that you can invest more in equities. Number two is bonds are a terrible investment. If you go look at the returns on bonds and the yields you're getting on bonds right now, after inflation, after tax, your return is pretty close to zero. It's not worth owning bonds. And so if you're an investor with an investment in horizon anything longer than a year or two, it probably doesn't make sense to be in bonds. And so dump bonds, buy stocks, and something that has a hedge. Now, there's certain types of real estate that would go into, certainly not commercial real estate. I would say office type stuff in real estate, because people aren't going into the office as much as they used to, and companies seem to be getting used to the fact that, hey, we can save a lot of money on rent if we have our employees work at home. And that may even offset some of the productivity loss. I know the people try to convince us that productivity is better now that people are working at home. I don't think that's true. I think there's more people horsing around than ever at home and not putting in as much time. Now, maybe that's made up a little bit because they're not commuting. And maybe that's a little bit of a benefit. But I don't see that. And I don't see employee development, right? Good. If you're coming out of school and then now you're going to work at home and you're going to miss out all that networking kind of stuff and mentorship that you get by working in companies. But there's still lots of real estate that is good. You know, data centers is going to be one of them, of course, which is all sort of private equity at this stage. But there'll be a lot of public companies coming into the space over time, because these people that are building this are going to spin it out into REIT type structures, I would guess, at some point. And then logistics, very good, because we move stuff all over the planet or all over the country. Products that get imported and then moved around and things like that. So there'll be pockets of real estate that will do quite well, and things like that. So you're looking for, I think people are starved for things that provide an inflation hedge, and stocks are the easiest way to get there. And I think that's why stocks are higher. I'm going to guess volatility in stocks is lower now on average than they were, I don't know, 20 years ago, because of this idea of this Fed put, maybe 30 years ago. And that gives people more confidence, and they pay more. And finally, we've had this shift, old economy to new economy. And old economy was about making things, cars, refrigerators, things like that. And it turned to software. Essentially, everything became software. As Mark Andreessen said, software is eating everything. So every product was some kind of software product to make your life easier, or if there was some kind of manufacturing, it had a big software element to it. And software is not capital intensive. All your money is spent up front in developing your product, and after that, you can manufacture or distribute an infinite amount of your product with virtually no cost.
Incremental cost, yeah.
So I think that's something that explains, the higher valuations. I think we're going into a period now where AI is going to beat up software, that we will have choices of not necessarily buying our software services from some enterprise software company, that you'll be able to make something more customized for yourself, and eventually have a better product at a lower price. And I think that's why companies like ServiceNow and Salesforce are taking it on the chin.
Adobe, I think, Intuit,
Yeah,
or other companies in that space, software as a service.
yeah,
It's interesting. So, Mike, it's interesting you bring this up, because arguably the best known software company in the world is Microsoft.
yeah.
Now, Microsoft, a little bit different than the aforementioned, and also one of the major hyperscalers. So, tremendously profitable, and hasn't quite suffered the same fate as some of those others in terms of the amount of damage done, but it has also rolled.
It's taken a beating, but not as bad. Yeah.
Yeah, not nearly as badly. I mean, it's down, but not nearly as badly. But actually, I think I'm interested in looking at them in particular, because I'm starting to think that these businesses have more in common with older industries than people would like to admit. And what I mean by that is, one of the justifications we've had for these higher multiples has been that modern economy stocks are asset light. They have these huge margins and all the rest of it. And that has historically been true. But then take a look at these numbers. And this is the CapEx stuff that I'm looking at down here.
Yeah.
And I'm saying, okay, so in this and the next let's look at the next fiscal year. So the next fiscal year, it's about $125 billion of anticipated CapEx for Microsoft. And that is double what it was just 2 years earlier.
Yeah.
And these are huge numbers. I mean, we're talking about incrementally $60 billion worth of growth over the course of just a 2-year time frame. Where is all that money going? Well, a lot of it is going straight to NVIDIA. NVIDIA, 19% of the company's revenue, give or take, comes from the CapEx at Microsoft.
Yeah.
Right? So that's a really big number. Now, people will also remember, possibly, that Meta, which is also a big spender in the space, but several years ago, was, they changed their name to Meta, as in the metaverse, because Mark Zuckerberg believed that was going to be the way of the future. And the equity markets didn't like that one bit. That was right in this time frame
Yeah,
here.
they didn't
So,
see the vision. Yeah.
they didn't see that as a great scheme. They said you're investing way too much. And actually, I should probably zoom in on this a little bit so we can get a better sense of just how sharp that decline was. But this is between mid 2021, we'll call it. Looks like it was about July of 2021 to, so we'll look at July to the end of 2022. Let's take a look at how this thing did in that period. So I'll go to this. And this was, a profound decline in the share price as shareholders said, you're investing too much. This isn't going to turn into profits. This isn't going to turn into real money. People probably don't remember it. Stock lost over 77% of its value,
Yeah.
peak to trough, in the 21-22 timeframe. Now, all of that turnaround, what a phenomenal buying opportunity this proved to be.
Yes,
in
but it turned
November
around
of
because they
2021.
quit. They more or less.
Exactly. They said, "Oh, wait a minute. Oh, you don't like this? Yeah, we're getting a little tired of it too." So, um, what has happened since is this.
Yeah.
Now, this stock also has broken below the average. Here's my question for you. Do these companies to you begin to look and feel either like old economy stocks, or to me, when I look at them, I'm saying they're beginning to feel a little bit like the communications businesses, like the old telco companies. In other words, you invest in all of this hardware, and that essentially is the service you provide, is all of this technology. Your technology stack is what people plug into. They pay you a fee for that,
Mhm.
and that's nice. You get recurring sort of subscription revenues. I don't care whether it's a phone line or internet service, but the problem is that hardware wears out. It ages out. It becomes obsolete. How do you move to that type of a business and look at that capex and say, okay, well, this is not one and done. It can't be. Those server farms don't last forever, right?
Yeah. Well, this is if you go look at any of the server farm companies and I've never understood why people love them so much when they did, even before the data centers that for AI was around, is they'd fill up a warehouse full of servers. 3 to 5 years later, they would, the CPUs, GPUs are much stronger. So now they've got to tear out the old, put in the new, but the new requires more electricity. And so now they're in a position where, do we walk away from this building, or do we retrofit the electrical services going into the building? So if they needed, let's say for a number, 50 megawatts to run the building before, now they need 100 megawatts to run the building. And they were stuck between these things. Do we just change our electrical, or should we go someplace and just build a brand new facility? It's all very expensive. And if you looked at their cash flows over time, when they weren't investing, yeah, they were making a lot of money, but every 3 to 5 years they had to replace everything. So I'm not sure that's a great business. I think there's a great deal of paranoia about who's going to win this race, that everybody feels like they have to win, because if they don't get agentic AI first, they're going to lose. And if they lose, they're going out of business. And I think one could make the argument that you've got all these big companies putting 50 billion, 75 billion into data centers, and there's a whole bunch of them doing it, that this may very well end up being the case where 1, 2, or 3 win. And so they do okay, but the ROE for the industry is an abysmal number, like nothing or maybe negative, because the 3 will win, the other 15 or 20 that's trying to play the game lose bigly, and they tear the average down. Now, I don't know if that's the case, that if you're not the first, or very near the first of getting to agentic AI if you in fact lose. But that's the fear. And my understanding is I was just reading an article and I forget which one it was, but one of the big AI makers said their latest version of their AI that they released was like mostly written by their previous version of AI. So AI's getting into this self improvement uh, um, situation. So maybe some AI is going to write a book and it says the better me, um, and and it'll become a bestseller amongst.
Yeah, I mean, coding, I think, is a job that is, you know, it was the hot ticket 10 years ago. I don't think many people feel that way about it now because many feel that a lot of this work is not going to be done by humans.
Yeah, well, I
It
think a lot of it
brings
will be it'll get written by somebody else. A human will get involved with that testing process, which of course you don't need quite so many people um, to do that, just to make sure it's doing what you say it's going to be doing, and out it goes. And I think software development might look a lot like spreadsheet development does today, where everybody can make a spreadsheet, or at least
mm-hmm.
in the business world should be able to create a spreadsheet. Um, and I think that may very well be where we're heading with programming, so that if you have just even a basic foundation, you can get AI to write it, and then the average person will have just enough skills to test it, run it, and say this thing works, and they'll use it in their job. May not
So
mass
let me
production, but
ask.
for themselves.
So let's ask about another Mag 7 company that has taken criticism because they had not seemingly either hopped on the AI bandwagon or invested in it as heavily or offered a service or a product associated with
Mm-hmm.
it that and that was a knock against it that I'm starting to wonder whether it might actually prove to be a competitive advantage. I'm talking now about Apple. So in a way, I kind of feel as if Apple is sitting on the sidelines, and what they have is they have the benefit of having almost 40% of the population sitting around using one of these things.
Yeah.
So they have the outlet. They're getting service revenues. They're getting hardware revenues. The AI battle is being fought. It's not clear who's going to win. Do you think that Tim Cook and the gang are sitting over there thinking, you know what, why don't we let them slog it out a little bit? And we'll sort of see where this goes. We will, of course, and I'm sure they're investing massive sums, but on a relative basis, not as much as some of the others. I mean, if you look at Meta is basically investing all of their cash flow
Mm-hmm.
in this. Um, do you think that they are going to be, because they have outperformed Microsoft recently? They are also a little bit lower than they were, but certainly not much. Still above their 50, 100, 200-day moving averages. What are your thoughts here?
Well, I think they've I don't know if Bloomberg can pull it up, but a chart of their free cash flow. I think that number is just fine. They're not blowing their money on that. I think a lot of the money being spent.
Look at their capex. 15 billion is what the same time that Microsoft's going to have 125 billion. Their capex is going to, is going to be 15,
Yeah. Um,
which is pretty remarkable. I'm just going to get rid of the revenue line and the EPS line so we can just look at
the
this.
red one.
Yeah.
Oh, so they think
And
it's
you
going
can
to
see
come.
that it's kind of cyclical, but
Yeah.
we'll put it 10 years, 10-year number on there, and you can kind of get a sense for how this is going. It's
I'm sure that
following
lines
a
up somehow with the
steady trend.
product life cycle of phones, for example. You have a big capex for each new phone that comes out, and then it comes down and then goes back up. I think to your thoughts that they're doing a Muhammad Ali rope a dope. They're sitting back and letting the other guys swing and swing and swing and exhaust themselves. And while they're sitting back and saying, well, there's 20, 30 different companies going at this, substantial companies going at this, taking different angles. Do we have some kind of competitive advantage in this space that the other doesn't, that we should try to lead? And I would guess their answer is no. So they're saying, well, let's just see how the market morphs and see what kind of products people want and what kind of revenue models might work. We have the platform, and as soon as we know what works, we'll build what we need to build and put it on our platform. And they will get, from the retail standpoint, the $20 a person. So everything I read about AI right now is all the money is coming from things like the enterprise software companies, that they've essentially outsourced AI and embedded it into their software. And when people use it, let's say they're going to Gemini or something. Gemini is billing, let's say, services now, and so they are getting, the AI companies are getting money from the institutional market and very little from the retail market. And I can see the retail market being one in which a couple billion people subscribe it. $20 a month, but I don't see them subscribing to 5 different services or whatever. It's gonna be like a phone. You subscribe to one, you're gonna live with whatever choice that you have. And I think that's where they're ultimately gonna go. And then what they'll do is what they've always been good at is user experience. And once they figured that out, they'll figure out something that'll be very good on user experience. And everybody will be surprised. Oh, look at this thing that they came out with. When in fact, they've been doing all kinds of experiments behind the scene.
So,
oh, good one.
First of all, it's interesting. I do subscribe to 4 different LLMs. Now, my reason for doing this is probably different than most, which is I'm doing it so that I can see how they're competing with one another. I use it as my real world barometer for, how they're doing relative to one another. So I will often have Claude, Gemini, Grok, and Chat all up on separate tabs of a browser. I will create a prompt or a query, and I will run it on all of them concurrently and compare their answers. So what I'm sharing on my screen right now is a business use case that I don't know. I'm not sure how many other services are doing this. Bloomberg is obviously a very expensive monthly service.
Yeah.
It's $3,000 a month plus. Some of the add-ons to that, by the way, are some of that's market data, so that money doesn't necessarily flow to Bloomberg per se, but let's just call it $3,000 a month. So what is this? This is a beta product. Not everybody who has the Bloomberg terminal can see this. I realize that this is, I'm going to blow this up, but it's probably not that helpful even when I do it. This is called Ask Bloomberg, Bloomberg AI beta. And effectively, this is their version of a large language model. So you can ask a question in here, much the same way that you would to Chat, Grok, or whatever. Now, I was supposed to actually have a meeting with them today to find out a little bit more about their approach. I'm going to be speaking to somebody at Bloomberg next week. My understanding, and I apologize to anybody at Bloomberg if I'm getting this wrong, but just based on what I have been told, is that they essentially have relationships with most of the large LLMs, and they basically are doing something similar to what I've been doing in a manual way, which is using all of the large ones, comparing the results, scoring them, coming up with a proprietary metric, and then utilizing whichever they think is the best engine at the time. So this is a B2B solution. That is to say, I assume Grok, Chat, Gemini, Claude, all feeding into Bloomberg, and then Bloomberg users relying on Bloomberg to say, this is the best of these, And of course, Bloomberg has a massive amount of data. So if there's something wrong, they probably have mechanisms for testing that,
Yeah.
because, one of the big common complaints that people have had about large language models, and our producer Jay, who can hear us both right now, knows more about this than I do, because he also does, among other things, a decent amount of programming. The hallucinations, incorrect data, things that I think the average person who uses these might not pick out. You would identify it. So, for example, when you use LLMs to support your work, you've written books on many of the topics that you're probably using these things for. So, if they're making obvious errors, you're much more likely to be able to pick it up
Yeah.
quickly. Because I have certainly seen that. I will query these systems on the types of questions that I would expect someone who's relatively advanced in our areas would ask me, and then compare the responses that they give to the ones that I would have done. And in many cases, I will answer a question, and then I'll go in and see how they answered it. And one thing has become very clear to me, and that is that they are improving with shocking speed.
Oh yeah.
And I find it to be a very useful exercise, because very often I think their answers are they're better than the one I would have provided, and certainly they're better than the one I would have provided in a short period of time. Because for me to get something good and coherent, where the points I want to make are ordered in the best way, takes a lot of time and a lot of work. I write a strategy piece. This is hours. In some cases, many hours to put that together, and then to go and verify the data. I ask one of these LLMs, and it's done in 30 seconds, and it comes up with 1,000 words.
Yeah.
And it's quite remarkable. And I look at that and I think, for how much longer are people going to rely on human beings when they can get their answer so quickly and so neatly constructed? And the only distinction is that from time to time I will read it and think, yeah, that's not right. That's not right.
Mm-hmm.
But there, eventually it's going to come to pass that that's probably not going to happen that often, or it won't matter. I think that's the biggest risk, is that it won't matter, because people will become so reliant on these that some of the stuff isn't going to get cross-checked. I worry about that, because then I feel like there's going to be sort of this incestuous information pollination process whereby the wrong answer is going to get perpetuated, simply because it's generated with such speed and then disseminated with such speed that the correction doesn't get addressed in suitable time. What was the old saying? That a rumor makes it halfway around the world before the truth gets its boots on, or something like that.
Yeah.
And I have a feeling that this is yet another example of this. But, maybe technology will come up with a solution to that too. What are your thoughts?
They will. It's getting better, and it's getting better faster, like hallucinations and stuff. That's getting better far faster than I thought it would. And then there's a couple other things that are going on that I think will make it better. And one is this idea that people will be using LLMs to produce LLMs, and they'll self-reflect and improve themselves over time. And I think that process is going on right now. One of the questions I have is, what is the valuation for these SaaS companies going to be? Are they going to turn into companies that look more like utilities, and they're going to trade at 10 times earnings because they're going to be forced to reduce their subscription prices to keep people from switching to say, screw it, I'm just going to, because how many Silicon Valley firms going like, I'm not going to subscribe to Salesforce. Let's just spend the next 3 months and have an LLM build us our own systems for HR, data sharing, all the things, our business processes, all that kind of stuff. And then we don't have to pay them a fee anymore. Not only that, we can customize that process to the way that we're going to do things. And 3, hidden inside of there, we can have anything proprietary that won't get outside the company. And that's what I have been wondering. So, because that asks the question, that's another way of asking the question of how low do these share prices go? You've got companies like Services Now and Salesforce that are down big. I don't know what it is, 50, 60%. Do they have another 50 or 60% down in them now? And then so they become commodity plays and they've got to defend their businesses more like commodities than anything else. Because software is the one thing about software is abundance.
Mm-hmm.
And because there's just no limit to how many copies you can have. And at produced at a very marginal price. That's the thing that I have been um, really trying to work on because it either that's going to happen or SaaS companies are dirt cheap right now. That
So,
everybody's
you just mentioned.
overreacted to the potential um, competition.
So what I pulled up now is you mentioned utilities, and are some of these companies going to trade at a utility multiple? And then you threw out a number. I think it was like
Yeah,
10
that's
times.
too low.
I think I was looking at an Intuit or something like that recently. It was closer to 15. Utilities index is actually trading around 19 and a half, which
Yeah,
is probably a little bit towards the higher end
yeah.
of the range since 2006. Although, just to put things in perspective, it's not as if that range is so broad.
Hmm.
I think first of all we can probably dismiss this 2008
Yeah.
era multiple. I don't know that that's really a big difference. So I would probably just cut that right out. What is the right number? Then of course there are some people who are saying that utilities should trade at a higher multiple because they are going to be more of a growth industry than they have historically been, in part because of the anticipated sharp increase in demand for, among other things, data centers. So, if we think about it, as we deindustrialized, industrial use of power and things like that would go down, of course. But if data centers are going to create a whole new demand that didn't previously exist,
Hmm.
and that's going to be recurrent, then that would justify a higher multiple. So I guess because utilities have traditionally been thought of as a defensive place in the market, if some of the sectors we've just identified are a little riskier than they have been, how do you feel about utilities at their current valuation? Because they have often been considered to be a fairly safe haven. Is 19 times, and this is 19 times trailing, by the way.
Yeah.
Is that still a reasonable place to be getting into
I
it?
think it's okay at 16, 17, 18, 19, because there is going to be rapid growth. Now they are being constrained by generators. So in a combined cycle system, you boil water, and then that runs a turbine, and then you take that waste heat and you heat it with some natural gas. You might run a jet engine and fire it a second time to use your heat, and you're done. Uh, and that's a combined cycle. That's the most efficient way to convert heat into electricity. Now we've got a shortage of the turbines and the jet engines that are used to drive this stuff. So I think the
Hmm.
growth cycle is going to be 10 years. I mean, I think utilities
Is
would be
this good
growing
for
fast.
GE?
What?
Good for GE
Good
then?
for GE and good for Alstom, the French
Mm-hmm.
company that makes um, these products as
Is this
well.
the GE? Is it the GE Vernova?
I
Is
think
that
that's
the?
Vernova, yeah.
Yeah. So I believe they manufacture the power systems, and that's one of the reasons I think the stock has done as well as it
Yeah.
has. Right now, it's trading at all-time highs. How's that?
Didn't take long,
Very nice.
go a year, and it's gone from 300 to 900. Got a three bagger in about a year.
Yeah,
That's
it was 115 back on the 24 March of 2024.
yeah. And so they've
So
got,
that's
I don't know what their
very
backlog
handy.
is, but a nice healthy backlog. And making these things are very difficult. The manufacturing tolerances are, getting measured in microns.
Mm-hmm.
So it's
So
not like
Steve
somebody else can
Garcia.
just pop up a company and go like, we're going to compete here.
So we got a couple questions which I think are probably worth an answer. The first one from Steve Garcia. Do you guys notice a significant difference in quality of answers between free AI and paid AI? I recently bought a subscription to ChatGPT and I can't detect a big difference. Uh, I'll ask you that question and then I'll provide my
I
answer.
have been using Grok, and I think there's been a huge improvement from about 18 months ago when I started to use it, where I felt like I
It's a
had,
paid version?
yeah, it was a paid version. I felt
Mm.
like I had to check everything that was coming out. I'd double check it if it was grabbing some data, and that kind of thing. I think it's very useful now that when it does it, it gives you the reference. So it makes it easy to at least to go find where they're getting data. Now, just because something on the internet doesn't mean it's true. So if it goes to,
Mm-hmm. No.
yeah.
So
So what I was trying to say is that I've seen a great deal of improvement where I feel like I don't need to check as much and it's giving you references. The one thing you do have to check is if it's going to get data from a website someplace and that website is wrong. I don't know how the LLM picks that up unless it's going to three places to triple check itself before it gives you an answer.
the improvement that you're referencing though, is that in a paid version or in a free version,
That's
or is it paid versus free?
that's in just a paid version. I've just been using a paid
Okay.
version of that for like 18 months.
So
I've been using well, I want to start trying Anthropic. I keep reading that they're kind of jump to the head of the line and quality of their product. Um, but Grok is the one that I've used the most,
hmm.
and
So Claude is the Anthropic
yeah.
product, and I do have a paid version to that. So I would offer the following, even within both the free. Well, actually, I don't know because I don't have free versions of any of these. So I
Mhm.
have paid version of Gemini, paid version of Grok, paid version of Claude, and paid version of Chat. Is that the one I didn't mention?
Yeah.
But yeah, all of these. And then, of course, I have Ask B in Bloomberg. So my observation about the paid versions and also the free versions. First of all, I assume this is true for free, but because I don't use free anymore, I can't say. But there were different models that one could use even within each platform.
Mhm.
And they tended to have a more tailored focus. In other words, are you a programmer who is looking specifically for something that can aid your work in that area? You would use one model. If you are a technical expert who was looking for certain types of answers specifically designed around your workflow, in some cases they would have a version of the application that you could use. And actually, I don't even know why I'm just speaking about this. Why don't I just bring up my? Oh, I better double check. There's no password, so I'm gonna bring all these up right now. So Chat, Gemini, because like I said, I have paid versions of each of these. Oops, Claude, Chat, Gemini, and Grok. Okay. All right. So nothing too secret showing there. Okay. So I have Super Grok over here, but in Chat, um, there, see up here,
Yeah.
there are they have legacy models. I can choose this one, the instant, the thinking one, and I can default back and forth. Ask Gemini tells you which version you are using, and then you can change which one you're using. Notice down here, Advanced Math and Code with 3.1 Pro.
Yeah.
And I have, you'll notice up here, you can barely see it, but that's
You
the
get
Pro
Pro.
version that I have. Over here, Claude, same thing. They have different variants that you can use. And now Opus, which is, okay, I don't have access to Opus because it's saying upgrade. So I have to upgrade to
Pull out your wallet.
Claude Pro. Claude, yeah. So whatever it is. So I would make the following observation, which is one of the reasons I got the paid version was because I wanted to see what you get for your money. So I could sort of compare like with like. So if this is going to be a $20 a month and that's another $20 a month. So I could say for $20 a month, I can have this, 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 or this. And how do they perform with each other? But there's another reason for the paid version. And that is that I sit in front of 8 screens 10 plus hours a day. And I look at stuff and I'm researching things. And because of that, I will maybe hit them pretty hard. And because I hit them hard, I think there are query limits on the free ones that it'll say you've used up your time allotment for, I don't know, the last 30 minutes or something. But I vaguely recall that. Perhaps somebody can confirm that for me because, again, I've had the paid variants now for probably about going on a year at least, I think. I'd have to go back and double check, and this is also interesting. You see over here, oops, what just happened? So I was going to say that it's making Grok not availing itself particularly well right now. That's probably my user issue, but it was offering suggestions of things that I might be interested in there. Something else that's interesting. If you look over here, you're going to see, I actually had a GE Veranova valuation thing that I asked it to write up. Now, what is interesting is that in Gemini's case, it kind of knows my use case. And it will say, so it's looking at the question from my perspective and will often come back with its responses based on my professional role.
Okay.
So we'll say, as an investment strategist, as a derivative specialist, here's some answers, from, it's basically, it's guessing the direction or the reason for my questions. I will often also have them try to make counter arguments to the answers that they provide, and then even provide one answer to the other and, say, can you refute this? That kind of thing. I find that to be a very useful exercise. The other thing that I have done is I've engaged with back and forth with them from time to time, just to see, is it spoon feeding? And they do this a lot. Anybody who has ever used these things, one of the things you'll begin to sense pretty quickly is that they spend a lot of time, and this makes sense, right? Because Google, now Alphabet, engagement's hugely important in everything else they do. Their search engines, YouTube, you name it, right? Advertising is what they're in. So what I've spent some time doing is how much do they try to pull you in just from a human perspective? They're really good at it, right? They respond almost like a human would, but one that's very flattering, right? You can probably tell it not to be as flattering, but, oh, great point, this and that. It becomes very engaging. And Steve had another question. There we go. So for some reason, I use AI as a tool for my work. I'm a physician, Steve Garcia says, and it's great for helping diagnose rare diseases, and it's fast for some radiology, but it can't replace bedside interactions with patients. I would imagine not yet. It's really interesting that Steve brings this up because I have heard this referenced before. They have said that in the case of medicine, and this is probably true in your work and mine too, which is that sometimes you can have somebody who is new to a field who is more likely to pick up on something unusual than somebody who's been at it for a long time. And that's because a lot of it, of our experience and our expectations, we use heuristics in our experience to describe what we see. And if you have something that's really unusual, maybe you just got out of medical school, you read it in the textbook, but now you've been practicing for 20 years, you've never seen it once.
Yeah.
Right? Radiology is another situation where there is so much material to go through. The pattern recognition is probably far better for a machine to do than for us. And it makes me wonder about things like security selection, that when it comes to picking out little inconsistencies, the things that might set off a warning bell, like, the Jim Chanoses of the world, find me good short ideas. The little tells that are indicative that something might be wrong. We tend to look at things from a high level. How's the market doing? How's the sector doing? How's the industry doing? Then we look at the company and we look at their financial statements. Probably more often than not, we take them at face value. Do you?
Yeah, I take the 10Q and whatever at face value, whatever they say, I assume is correct.
I mean, Ernst signed off on it, right?
Yeah,
So we kind of assume that, this is the best barometer. And then we take that information and we try to distill it into some kind of a standardized way, because not every business is like for like. So you try to template the stuff that you get into a way that makes it easier to relate one security to another. But in the process of doing that, if there are little tells in the financial statements that should be throwing us off, we're not even working with the original financial statements anymore. We're working with some spreadsheet we built where we were pulling assumptions from one place and massaging them so we could have a metric that was easy to compare. And I wonder whether, for picking out shorts in particular, these things are going to be better than most humans would be. Go find things that don't jive. For example, this Chinese company says that they are, in the trucking business, and then, you have a satellite photo that says, yeah, except they say they've got 100 trucks. They've got a parking lot that'll accommodate one, and there's nothing there except a rickshaw.
yeah.
Yeah, so I'm interesting. But Steve, I really appreciate that insight, because I have seen that brought up in the past. I'm not a physician. So I couldn't opine on it. The other thing I would imagine this is going to be very good for, or I would have thought it would be good for, but it turned out not to be, was the law. Because there's so much material to get through that you need to distill in a hurry. The problem has been, though, that that's where one of the hallucinations took place, right? The law firm got into big trouble. They basically were dealing with a case. I think one of the producers was the one that brought it to my attention. And the thing was making up case law.
Yeah.
It was making up cases. They never existed. As it said in, case versus case, whatever it needed to justify its existence. And quite remarkable. All right. So, well, let's see. I mean, what are your thoughts? Because we haven't had a chance to talk about this. Supreme Court ruling on tariffs.
Yeah.
Saying that the administration superseded their authority, which in a way I'm unsurprised by this, because it, if you really get sort of down to the heart of it, the ability to tax does appear to be within the hands of Congress. That's probably right. They have allocated some of those abilities to the administration or administrative branch when it seemed appropriate to do so, but they didn't transfer their authority ultimately. What are your thoughts on that, and what do you think? What are the implications, and for what stocks?
I think they're gonna look for other, and they've already said this. They have other arguments to make, that what they're doing, for example, has to do with national security, and the president has authority to do various things with regard to national security. And some of this, I think, is very true, because if you don't manufacture anything and you go to war, you're toast. I mean, it's one of the reasons why the Allies won in World War II, is that we very quickly in this country turned car factories into factories building aircraft. And we're kicking out aircraft like there was no tomorrow. Then we're kicking out machine guns and bullets and everything you needed to prosecute the war, and nothing flat. We can't, it's questionable whether or not we could do that now, especially since a lot of this stuff is run and requires rare earth metals and stuff like that because everything is so electronic driven. What's it going to be like in we're going to have to be able to manufacture robots because whether we like it or not, future wars are going to be fought with robots.
They're being fought with drones right now,
Yeah.
and so that's
So
boy. It seems like the age of Terminators very fast approaching.
yeah, so we're going to have Skynet doing things. That said, I think whatever ruling the Supreme Court did was the right one. It's these authorities lie with Congress. Now, I always thought that Congress had written some laws to give the president free reign to do what they wanted, because you could imagine trying to negotiate anything with what is it, 572 Congress people and 100 senators. Like they'll never agree amongst themselves. So how would you ever negotiate a deal between them and a foreign country? Um, so in the past, when we've negotiated trade deals, this stuff was always the Congress gave the president to do this. I always thought that authority was permanent. And so that's why I didn't never got really worked up about it from a constitutional standpoint. But evidently, that's not the case. And um, if they did something in the
I
past,
think
they
what had
sunsetted.
happened was yeah, I think that it's, well, first of all, yeah, I mean, I think the authority on this side should reside with Congress. There's a lot of authority that needs to reside with Congress, and whatever your view of whoever occupies the White House at one point or another might be, I would simply offer the following, which is that, when the founders came up with our system of government, flawed as it is, one of the things they certainly endeavored to do was to avoid the ability of either one branch and certainly one individual from coming in and just totally turning the apple cart over and saying, we got a new way of doing things and it's going to be my way and that's it.
Yeah.
So that it was intended to be more deliberate. We certainly have recognized that it can be a pretty messy process at times, and in many ways probably not really working, and that needs to be addressed. But I think it would be far better for Congress to step up and say, okay, we recognize that there are some issues here. They need to be addressed. And so we are going to provide the following limited authority to the administration to impose tariffs and other, and other rules as they see fit to contend with the
Yeah.
following issues with it, and then just put some guardrails around it. I have a feeling that we would not have been here if things had been handled. I don't know whether haphazardly is the best way I would describe it, but let's just say the Liberation Day numbers that got held up. Was it in the Rose Garden? I can't quite remember, but he came outside and somebody had a big poster thing up and he said, we're going to have reciprocal tariffs. And then we saw some of those numbers and I saw the size of them and I thought, oh my God, where did that come from? How is that reciprocal? And they were saying, well, we're going to factor in VAT and this and that. And I thought, boy, this seems a little slapdash. And I'm not saying that many of those weren't justifiable, but I have a feeling that we would not have found ourselves in court and where we find ourselves now had there been a somewhat more orderly process in the beginning. What do you think?
There's a little bit of that, but I think that's part of the president's process. Is he pivots very fast, changes his mind all the time, and you can decide whether you like that or not.
That can be a strength. I
Because
mean,
it's like, okay, I
people
got
should
that
be able to
wrong. I'm
adjust,
going
but
to pivot and do something else. Some of it may be a bluff, and things like that. And it seems like a lot of people that are against what he's doing want him to lay out his entire strategy, um, so the whole world can see what his strategy is. And of course, anybody knows that's a dumb thing to do if you're negotiating something. You don't tell your opponent or your counterparty, whoever that is on the other side of the table, what your objectives are. Um,
Steve Garcia said it'll be interesting when the AI comes up with their own diseases, but I hadn't read one of the diseases that he supposed that maybe they'll come up with. Co-syndrome,
So,
co-derangement syndrome. Maybe that they'll have. Someone watched one or two of these live streams and
but
said just about enough of me. AI is going to say that's a thing. We'll see.
but and notwithstanding any of that, I'm very sympathetic to what the president is trying to do, because when I went to Michigan from 1977 to 1986, I'm in the Midwest. I'm seeing manufacturing companies get gutted while both environmental and tax regulation is making it harder and harder and harder to do things in the United States. In the meantime, there's all these incentives to go move your factory down to Latin America or China. And I saw towns, families, um, just gutted that people had a nice living, and then all of a sudden their product is being manufactured someplace else by somebody who makes 10% of what they do in the States, and they don't have any environmental regulation. So it's more expensive to do things here than there, even if your labor cost was the same. And so I'm sympathetic to that, because I didn't like the idea that we are going to do all our manufacturing overseas. I think China's economy is infinitely stronger than ours now, and that's not a popular or accepted view. But one of the things I like to look at for how well an economy is doing is just how much electricity they're consuming. And our production of electricity is going like this. China's just passed us like that. They now use like 2 or 3 times as much electricity as we do. That tells you that they are producing way, way, way more than we are. And I think their economy is much stronger. They're coming out with a lot of products that we can't manufacture here. We just don't have the ability to do it. We look at what we're doing, trying to build a tunnel to take people from New Jersey into New York. We can barely do it. Or look at California that can't build their high-speed train, right? And what do we got in China? China's got maglevs running around the place. And
Yeah, I'm
Japan's
going to leave
got,
us with this chart. I'll leave us with this chart, but this is Chinese versus U.S. electricity generation.
yeah, so that tells me that,
And this is only through 2024, and you can see the slope of the line. So to your point, we've essentially been flat in terms of our power generation in the United States over the course of the last 20 years. And over that same period of time, so basically from here, where they had about 35% of
Mhm.
U.S. power generation, and now we're about in 20 years, we have gone from a situation where they were less than half of what we did, so now we are much less than half of what they do
Mhm.
in terms of power.
Yeah.
And I think that's a very interesting and valuable proxy, because if you think about it, to your point, that power is being used for various purposes. Some of it's being used for turning the lights on and running people's PCs and keeping the air conditioners and the refrigerators going. Some of it's used for manufacturing. Some of it is used in, to your point, rail transportation, things like this. And there's no question that their productivity has been increasing at a much faster rate than ours has over the course of the last 20 years. And one way to think about, because people are always trying to compare our economies, and they're saying, oh, do we do it on a GDP basis? Do we do it on an adjusted basis, on a per capita basis, like a purchasing power parity? But I think you're right. If you simply looked at electrical generation and use per capita, you'd have a sense of the relative productivity. And if you take a look at this in Europe, you will see that where we have very, very modest growth, they've actually seen declines. And they have seen declines in productivity, and they have similarly seen declines in basically the quality of life, right?
Yeah.
So in real terms, their economies have been shrinking. Okay, so we've been at this for a little over an hour. I always enjoy our conversations. I hope those of you who have tuned in live enjoyed it, and I hope that those of you who are watching recordings of this similarly do it. Enjoy it. Please put your comments and questions into this video, not into the chat, but into underneath the description of the video, because if you have a more complicated question that might take us a little bit of preparation to answer, we'll look at those, and then maybe we can put some slides or other ideas together to respond to those. So Mark, thank you.
Welcome.
To all of you watching, thank you. And we look forward to seeing you back here same time next week.
Okay. Have
Thanks
a
for
great
watching.
day.